When the financial market fluctuates, where is your money? Think of a future where your investment portfolio can withstand any economic storm. Diversification is the key to that future. Some say that putting all your eggs in one basket is dangerous, but how can we really spread those eggs intelligently? Stocks can bring high returns, but what if the market crashes? Bonds are stable but offer low yields. Real estate seems safe, but it has its pitfalls. So how do you combine these elements to create a portfolio that not only survives, but thrives? The art of balancing risk and reward is more crucial than ever. Every decision you make can be the game changer between success and failure. Ever wondered why some investors always seem to be ahead? What are their secrets? What do they know that you don't? Today, we're going to unravel those mysteries. Find out how reviewing and adjusting your portfolio regularly can transform your finances. How the lessons of the world's greatest investors can guide your choices. This is the time to rethink your strategy and build a truly diversified investment portfolio. If you are enjoying this content, I ask you to subscribe to my channel and help me continue to grow and bring more relevant content. Continuing. How to build a diversified investment portfolio. 1. The first step to diversification. Know your options before diving into the world of investing. It's crucial to understand your options. Imagine a vast market, filled with different types of investments, each with its own characteristics and potentials. From stocks and bonds to real estate and cryptocurrencies, the range of choices is vast. Diversity is the key to protecting your wealth against volatility. Rather than relying on a single type of investment, diversifying allows you to spread out risk and maximize returns. Have you ever thought about what would happen if you put all your eggs in one basket? The risk of losing everything is high. Diversifying is like spreading these eggs in multiple baskets, decreasing the risk of significant losses. Each type of investment responds differently to market changes. When one sector falls, another may be on the rise, balancing your portfolio. This balance is essential for sustaining long-term growth. To get started, research each type of investment available. Learn about stocks, bonds, real estate funds, commodities, and cryptocurrencies. Understand how each works, its risks and benefits. This initial research is critical to making informed decisions. Knowledge is power in the world of investing. The more you know, the better prepared you'll be to build a diversified and resilient portfolio. 2. The art of balancing risk and reward. Investing is not just about where to put your money, but how to balance the risks and rewards. Each type of investment has its own level of risk and potential for return. The secret lies in finding the perfect balance for your wallet. Think of diversification as an orchestra, where each instrument has its role, but together they create a harmonious symphony. Balancing risks and rewards is an art. High-risk investments, such as startup stocks, can offer great returns, but they also come with the possibility of large losses. On the other hand, safer investments, such as government bonds, offer lower returns but with greater security. The key is to find a match that aligns with your financial goals and risk tolerance. This unique combination is what will make your portfolio grow sustainably. Diversifying between different levels of risk is essential. Include both conservative and aggressive investments. Regularly review your portfolio to ensure that it stays balanced. As the market changes, adjust your positions to take advantage of new opportunities and minimize risk. This continuous review is what keeps your portfolio agile and adapted to market conditions, providing steady and secure growth. 3. Exploring different asset classes. A diversified portfolio should include different asset classes. Stocks can offer rapid growth, while bonds provide stability. Real estate and commodities can add an extra layer of security. But how do you decide the right ratio of each asset? That's the key to building a robust and resilient portfolio. Each asset class has its own behavior and market cycle. Stocks are known for their volatility, but also for their high growth potential. Bonds, on the other hand, are considered safer investments, offering fixed and predictable returns. Real estate and commodities, such as gold and oil, can act as a hedge against inflation and other economic uncertainties. Understanding how these assets interact is critical for effective diversification. When deciding the ratio of each asset class, consider its age, financial goals, and risk tolerance. Young investors may be comfortable with greater exposure to stocks, while investors close to retirement may prefer the stability of bonds. Assess your financial situation and adjust your portfolio as needed. A well-diversified portfolio not only protects your wealth, but also provides opportunities for growth in a variety of market conditions. 4. The importance of regular portfolio review. The financial market is constantly changing, and your investment portfolio must keep up with these changes. Regularly reviewing your investments is essential to ensure that they are still aligned with your financial goals. As a gardener who cares for your plants, you must prune and adjust your wallet to keep it healthy and productive. Regular review helps identify which investments are performing well and which need to be adjusted or removed. The market can be unpredictable, and what has worked in the past may not be effective in the future. Continuous analysis of your portfolio allows for adjustments that maximize returns and minimize risk. This review process should be systematic and based on hard data and market trends. Additionally, your financial needs and goals may change over time. Events such as job changes, marriage, the birth of children, or retirement can influence your financial priorities. Regularly reviewing your portfolio ensures that your investments continue to meet your personal needs and long-term goals. This constant adjustment is what keeps your investment strategy relevant and effective. 5. Lessons from great investors. Learning from the masters can provide valuable insights. Great investors like Warren Buffett and Ray Dalio have time-tested strategies that you can adapt to your own portfolio. What are the secrets behind their success? And how can you apply these lessons to achieving your own financial goals? Warren Buffett is famous for his value investing approach, seeking out undervalued stocks with strong growth potential. Their patience and discipline are key characteristics of their success. He teaches that investing is a marathon, not a sprint. By focusing on the intrinsic value of an investment and maintaining a long-term perspective, you can avoid the pitfalls of the market and build wealth consistently. Ray Dalio, on the other hand, is known for his approach to diversification and balance. He advocates the creation of a proof-of-everything wallet that can thrive in any economic condition. Its philosophy is based on asset class diversification and risk management. Adapting these principles can help you create a portfolio that not only withstands market turbulence, but also grows sustainably. Studying the strategies of these great investors offers a clear path to success. Analyze your approaches, learn from your mistakes and successes, and adapt your tactics to your own situation. The accumulated wisdom of decades of experience can provide the guidance needed to build a diverse and successful investment portfolio. To think about diversification is to think about security and growth. Every investment decision you make today shapes the financial future you want. Maintaining a diversified portfolio is like having a reliable map in uncharted territory. What will be your next choices to strengthen your position? The market is constantly changing, and your wallet, is it keeping up with these changes? Reviewing, adjusting, and balancing your investments is more than a strategy, it's a necessity. Skipping these steps can be costly. How can you ensure that your portfolio is prepared for any economic scenario? Great investors weren't born great. They learned, adapted, and adjusted. What lessons can you apply from your strategies? Diversification is not just a concept. It is the bridge to a secure and prosperous financial future. Are you ready to take the next steps and build a portfolio that will stand the test of time?